Hello, everybody. Kirk Spano, Investing 2020s. Lots going on in the world and a lot going on with my investment letters. So why don't we start with a little bit of house cleaning, just to reiterate that some of the webinars that I do will be pre-recorded, and that will generally be the stocks of the week piece, or I will do pieces on individual stocks. To get those at first release, you will need the $1.99 membership on YouTube. That is where you subscribe, right next to where it says Investing 2020s. Why am I doing this? Because way too many free riders, too many people cherry picking the stock picks by watching the videos and never buying the investment letters and getting the full description and approach and technical analysis that would help us with our entries and exits. So I have actually gotten complaints from people, hey, you said this in a webinar, and so I bought it and it went down. Well, first of all, stocks go up and down. But second, if you don't buy the entire analysis, just say, oh, I heard you say the word on the internet where everything is true. Well, I've got a couple of words for those people. Zuck off. All right. Trying to get things for free without the full explanation, without the full concepts behind the ideas. You can go zuck yourself. And that's why we're going to do the $1.99, because those folks are too damn cheap to pay $1.99, much less hundreds of dollars a year for an investment letter. So to protect the integrity of our stock picks, I will put them behind a paywall until I see fit to release them to the free side, which will generally be after all of you have bought. So hopefully we will bring in new buyers after we have established positions. All right, that's number one on the hit list. Number two on the hit list is I have reached an agreement with an international marketing company, and we will be going global. So that should be fun. Seeking Alpha is at the core of that on the domestic side, but internationally, and for those who swing trade, fundamental trends will be the backbone of it. So we should see some pretty interesting growth over the next year or two by adding first Australia and then moving into Southeast Asia and India and Europe. Ultimately, we want to get the entire globe. I would think about 18 months out, we'll do a specific campaign into Canada and Mexico and the Caribbean, because, hey, who wouldn't want to hang out there? All right, what's going on in the world? Lots. And a lot of it is just what I told you was going to happen. U.S. existing home sales fall to 7-month low on rates and supply. There are so many people with low interest rate mortgages that they don't want to sell. They're locked in at 3-4%, and they're thinking to themselves, why would I ever sell this property at such a low interest rate? I might as well rent it out if I'm going to move somewhere else. Many of those people are just locked into that property. The reality is 60 to 80% of people just can't sell because they would never be able to turn a good enough deal to make it worth their while to do so. People who are cash rich are in a good seat right now. People who are cash rich are probably coming up on the best opportunity to buy real estate since about 2010, 11, 12. What am I saying there? What I'm saying there is that interest rates for about the next year are going to remain in this range before I think starting to come down next summer. We know that there are lag effects to interest rates, and that is why Chairman Powell backed off yesterday, said we're not raising rates, we're holding it in reserve. But the reality is that even though people decided that the narrative would be hawkish, said I see it as relatively neutral to dovish. I cannot imagine they would want to raise interest rates anymore. I think the next thing they're going to do is start fiddling with quantitative tightening, and that could happen by spring. Why? Because the economy is good. I mean, the reality is that the economy is good. And if we tighten it up too much on the monetary side, then all sorts of things that we want to have happen with the economy don't happen. And the simple fact of the matter is, the only way to control the labor rate on the monetary side is to cause a recession. Well, what good does that do? It doesn't help with the energy transition, doesn't help with GDP, doesn't help with anything. It doesn't help with the federal budget. So the Federal Reserve is in a spot right now where they probably have done all they can do. We wrote about 2 years ago, I wrote about how this was going to be a process of them reloading their bazooka. They've pretty much done that. I also talked about how we were going to see the great divergence. We've started to see it, but not really the upside. We've seen over the last 2 years that a dozen stocks, the Magnificent Seven in particular, have accounted for about 75% of the stock market gains. That means the other 488 stocks on the stock market, on the S&P 500, which is what people think the stock market is, haven't really done very well. You have one here and there, but on average, they're up like 2.3% or something. So virtually all the gains this year are from those top 12 stocks. And the reality is, if you go back to the top at the end of 2021, you still have hundreds of stocks underwater. Large caps, mid caps, and small caps. So what does that mean? If the Federal Reserve starts to back off sometime next year and unemployment doesn't fall, you have a lot of money going in the 401k plans. That's part of the whole negotiation over at the UAW. UPS just got a better retirement deal, more money in the 401ks, which goes into the stock market. So unless employment breaks, you better be a buyer in the next couple of months while you have a chance, because unless there's a war or a outright financial crisis borne by China, there just isn't a lot of risk in the world right now. And while the narratives are that there's risk, I haven't seen this little risk in a really long time. Now, I see some things on the horizon. Again, I've pointed to 2029 and 2030 is when we're going to have to deal with the baby boomer retirement crisis. I might be early on that. And I think this whole trend of private equity firms stepping into banker shoes and providing loans to companies that really have only survived because interest rates were 1%. I had that conversation with a private equity guy yesterday. You've got big private equity firms like Apollo, and I don't like their CEO. I think he is one of those big skim guys. Saw him on Bloomberg today just talking out both sides of his mouth. But if you're not following what I'm saying here, I'll catch you up. The banks are really tight right now, and the private equity firms are making loans to companies that they would normally get from banks. They're charging higher interest rates to make these loans to companies that need that money to exist. They were only existing because interest rates were super low the last few years, and now they're borrowing at higher interest rates, generally 5-year notes. How are they going to pay those back? So there's a lot of companies out there that just simply can't fundamentally pay off the debt that they're taking on now through the private equity firms down the road. It's going to be 40% of them default. It's going to be 50%, 60%. I don't know, but it's going to be a big number. Remember the financial crisis? We went from default rates on mortgages of 1% to 2% to up to 20%. But those are all backed by real estate. What happens if a third or 40% or 50% of the companies that are borrowing money now at higher rates from private equity firms default? There's nothing securing those loans. All right, so let's go another step into what's going on with the private equity. Do you remember collateralized debt obligations, CDOs, from 2006, 7, 8, 9? What is that? That was when a company, an investment company of some sort, would put together a bond portfolio and sell it to the public. And the bonds at the top of the portfolio would be A-rated, and then all sorts of bonds below it, based on mortgages, were lower quality. But they called them A-rated bond portfolios that they sold to the public, and pensions in particular, and all sorts of other institutions. Called them A, double A, whatever their super gold, beautiful, you gotta love us rating was. But really, it was full of junk. Mortgages on properties that weren't worth what the mortgage debt was, from people who didn't really have the credit or the income to pay those if they couldn't flip them or occupy them with a high rent renter. And we saw 20% of those mortgages implode, and that caused the financial crisis. What happens if an equal amount of money or more, and it would actually be more because companies are way bigger than houses, default? What if the default value is way higher? You've got all these millennials who think they're sophisticated investors because they have a high income. That's the definition. Shouldn't be, but it is. Buying private equity investments because the private equity firm says, hey, we got a deal for you. We have a portfolio of loans in companies that are growing. They're growth companies. And you can get an 8, 9, 10% interest rate while you wait for them to grow. But instead of them growing, they can't pay back the loan in 3, 4, 5 years. We know that a lot of companies don't make it, and that most companies go round trip. Round trip, what does that mean? It means that they start out, they grow, they get big, and then they come back down. We're seeing that with a couple hundred companies in the S&P 500, and every decade we see around 100 companies in the S&P 500 shrink. Now imagine that across mid caps and small caps and micro caps. For sure, that's where your biggest winners are, but it's more like 1 out of 5 companies are winners and 4 out of 5 companies are losers. And the 1 out of 5 companies that are winners, they don't need the loans because they're building revenue bases. They're going to back things. Sure, they refinance something here and there, but they have streams of revenue that are coming online over and over again, or they have sales that are increasing. So you're going to see a whole bunch of millennials, and this is another one that you mark. Timestamp this one. I'm telling you right now that all this private equity lending and then the packaging of those loans into products that are sold to people who think they are sophisticated investors, mostly millennials, is going to bite them in the ass so hard that it takes a chunk out. And that could be your next financial crisis. Now, if it happens at about the same time that the last boomers are getting onto Medicare, the mouthpieces, the talking heads, the narrative makers that have no scruples or no brains, a lot of times those things run in parallel, will say, oh, we're having a financial crisis because too many people are on Medicare and Social Security. We should cut those programs and then we should do a tax cut. That's the shit they're going to say. Remember that when it happens so that you can call bullshit. That is, by the way, my number one skill. My grandfather was a table-thumping Italian guy who believed the character came first. He taught us to hear what was really being said, to be able to call bullshit when there is bullshit. And we are at the very, very front end of a monumental shitstorm from all this private equity lending because they are lending it to companies that will never be able to pay it back. And they're going to package those loans into products that they sell to the retail side because the millennials don't know what they're doing when it comes to this type of investing. But they think they can because they qualify based on income as an accredited investor to do it. And now you have private equity firms and technology companies trying to slice them, dice these even more to get them to even all the people who don't qualify as accredited investors, which is, the other 95% of the people. So as you see these platforms come up to say, hey, we have a nifty deal for you, and it sounds too good to be true, the reality is that it probably is too good to be true. I do like the idea of being able to invest in a portfolio of real estate, but I don't like the way that certain people put those portfolios together. That the more people that buy things that they don't understand, the bigger the crisis that can occur. And I'll tell you, I talk to people on investments all the time. There's all sorts of people who have no idea what the difference is between an exchange traded fund and a mutual fund. Not a clue. But then I see some of these people buying variable annuities with riders on them that are incredibly expensive because the salesperson said, oh yeah, you get a guarantee. Don't really explain what it's a guarantee of, how it works, what it costs, who backs it, how it's backed, but it's a guarantee, so they sell it. They make their 7 or 8% commission. You need to be able to call bullshit. While things look great right now, because the employment situation is good, and I don't see a lot of ways for it to get blown up, unless the Federal Reserve just goes, zucking stupid. The thing to worry about is right here. This guy right here. And he's even throwing up the warning. He's telling you on the front end. He's doing it out of one side of his mouth. On the other side of his mouth, he's telling you junk bonds are too expensive. It's funny. They're packaging some of this stuff into new piles of junk. But he says junk bonds are too expensive. Like it's going to give him absolution. When this crisis hits, if it hits, I really hope people go to jail that time. Now, what else is going on in the world? That was the big, think about 7, 8 years out. Let's think about the next 1 or 2 years. What do we got going on? Well, the big thing we got going on right now are the first labor versus AI wars. And that's really what's happening in Hollywood. And that's even what's happening with the UAW, because as jobs become different, because machine learning is going to be able to build most of an EV, how do the people keep their jobs? They're going to have to learn new things. That's at the heart of this. Everybody wants to talk about the money. But of the 3 things going on in these strikes, it's the job security that's number one. How do we work with AI versus AI taking our jobs? So when they negotiate, they take pretty hardline stances. And the president of the UAW, Fine, has been really pushing super hard, and including the idea that he's going to try to get a pension for the UAW again. Can't happen. Nobody's ever run a pension well. Not the unions, not the municipalities, not the companies. Nobody runs a pension well. They should be able to, but sticky fingers, bad management, just poor investment philosophy get in the way. The only thing that they can do to provide better retirement benefits is just give them more money in their 401k. They deserve it because these companies are making a lot of money and the CEOs are pulling out tens of millions of dollars a year, right? Conceptually, it makes sense. But when you break it down from percentages to absolute dollars, in practice, it doesn't work. You can't give these folks 40% pay increases. But what you can do is give them more job security because as jobs change within the companies, they should be priority to take the new jobs to get trained for them. I think that's easy enough to do. I think it'll happen. I think they'll get a wage increase over 20%. I think they'll get a benefit increase of around 20%. Because when it comes down to absolute dollars, that's billions versus the millions that the executives make. And I'm not arguing that the executives deserve it or that it makes sense. You know, they've been skimming a lot of money for 40 some odd years now since the system really changed under Reagan. One of the sticking points is something called a tiered wage system. Basically, what that means is that people who are hired at different times are on different wage scales. So the UAW wants to unify that. Everybody has the same rules, which makes sense. I don't know why GM in particular is fighting that. It only affects like 15% of the people. I have no idea why they're fighting it. It's just part of them trying to skim a little something and they're looking for a spot to do it. So if the car companies are smart, they'll basically give the unions what they want on the two-tier system. Now, the unions want it to be settled based on 90 days. Once a person goes from temp to permanent after 90 days, rather than over a potentially 8-year period, everybody's on the same system. So right now, they're trying to bridge a gap between an 8-year two-tier system, right? It takes you 8 years to get off that system. The union wants 90 days. Companies have already come back at 4 years. So what's going to happen? It's going to be a 1 or 2 year thing, right? You're on the lower pay scale for a year or two, and then you get what everybody else gets. That could be 90 days. I don't know that you can even justify 90 days. Maybe a year. It'll be settled. If GM fights it, I'm not so sure that Stellantis and Ford don't give in. So maybe GM gets hit the hardest. But this is a very easy thing to settle if the management of the car companies essentially give them almost everything they want, work with the numbers, but say, we can't give you a pension period. This is the thing that is not on the table, is the pension. And you know what? That's just good negotiating by both sides. We'll see how long they play politics with it and whether or not this works out to be a long, big strike. Because this is one of the potential black swans. If these car companies get fully struck and none of the automakers are producing for longer than about a week, the ripple effects to the rest of the economy are pretty gigantic. It used to be, some of you old timers will remember this, as GM goes, what goes? America goes, right? As GM goes, America goes. It's not quite like that anymore, but the automotive industry, through its supply chains, and so, you know, everybody that has something, even at a tertiary level, that has to do with the auto industry, impacts right around 40% of the economy. Now, that doesn't mean that the shop down the street that makes something for GM is going to go out of business because GM is on strike. No, it just means that they don't have that slice of their business anymore. Might lower their profits by 10 or 20 or 30%. Depends how much they were supplying, right? The OEMs. But it could be a pretty big haircut. About 1 to 2% of GDP. Worth 1 to 2 points, I should say. Well, with the economy growing at 4 or 5% right now, that'd basically be cutting GDP growth maybe almost in half. So it's a big deal. I don't think it's going to happen. This shouldn't be something hard to settle if, and I probably said his name wrong. I think it's fine, but maybe it's Fain. I don't know. Guy from UAW. If he decides that they have to have a pension, then this strike's going to go a long time and it's going to do a lot of damage. If he gives back pension to get everything else, it'll work out. So keep an eye on this because it's a big deal. Ultimately, a couple of months ago, I told you that the dollar was going to get stronger into the fall for a number of reasons that are happening right now, including the Federal Reserve and the congressional budget negotiations. We are having that strong dollar moment now. It's why I backed off on publishing the options article, but I am going to do it today. because I want you guys to go slow and be discerning. There is some price weakness right now. I think it'll last most of the rest of the month, if not the entire rest of the month, and a couple days into October. You have to pay attention to the budget negotiations and see if we get a shutdown. And what you're trying to do is buy as much as you can right before the budget negotiations are settled. And unfortunately, we're probably going to see some starts and stops of that. They might do a 30-day extension. Then we just have to do this again at the end of October. So selling cash secured puts on some of these dips is pretty interesting to me. I've been managing my Paramount position because I just don't feel like waiting until next year to make my money back. I took some tax losses and then I sold cash secured puts the next day as the stock went down. So I'll end up getting back into Paramount with a net cost a little under 13. And I have captured a tax break. So I will talk to you about how to manage some of these positions in a way that allows you to capture a tax break and still get back into the stock in a month or two. It takes a little work, but you can do it. All right. Okay. So here's what we're going to do. We're going to take a break right now. I'm going to talk to you off air for a second. But keep an eye on these articles coming out over the next couple of weeks, because I think there's going to be a lot of buying for us through the end of the year. And I think that it starts just about now, because this dollar is not going to get very weak once it starts the weekend. But once it stops going up, that'll probably be when the stock market feels better. And sometime next year, the dollar is going to drift down, but it won't drift down a lot, because remember, there's not another alternative to the dollar right now. Maybe in a generation, maybe in two. Still love Bitcoin though, because it is an international currency hedge. I told you when it was in the teens to buy it. I'm telling you while it's still in the 20s to buy it. It's going to six figures next several years. So if you can quadruple your money the next 4, 5, 6 years, doesn't matter to you the shape of the curve. Just buy cheap while cheap is cheap. All right. I will talk to you again on Monday about some specific stocks.